Nvidia, Tesla, Palantir, they all seem to be on steroids after Trump's visit to Saudi Arabia. But this time, everything is completely different from usual. Institutional investors are losing money, hedge funds are capitulating, and, conversely, retail investors are euphoric. Against this background, American banks suddenly cancel the recession and turn into bulls. What will the coming days bring us? Let's figure it out. This week, the stock market was dragged by Nvidia and Tesla. Nvidia has grown 15% from Tesla by 21. In the cryptocurrency market, the whole picture was dragged by Ethereum and its derivatives, for example, Lido Stake Finance. It has grown by 18.5%, even more than Ethereum itself. Both on the stock market and on the cryptocurrency market, the fear and greed index has grown sharply and is now at the greed levels. If you look at the picture this year, the fear and greed index has grown to the highest values in 2025. But a month ago it was only 6 points, and for comparison, during the coronavirus, it fell to 8 points. Now it is 71 points on the crypto market. And this is already high greed, but not yet the maximum. Along with this index, risks in the markets are also growing. This is natural. It is best to buy when this index is at the bottom, below 20 points, and it is best to sell when it rises to 75, 80, and even more 95 points. The higher, the more willing to sell. A simple example. If, since February 2000 of the 18th year, every time the fear and greed index fell below 24, you would buy Bitcoin for $100, then during this time, you would have invested $50,000 in Bitcoin, acquiring 3.5 coins. At a price of $100,000 for Bitcoin, this is $352,840. That is, $50,000 would have been turned into $350,000 in just 7 years. Of course, using only one indicator is risky, so I would take into account several at once. The Fear and Greed Index, a survey of investor sentiment, the behavior of the Volatility Index, recessionary expectations on the poly market, Google Trends, and, of course, indices related to macroeconomics. For example, this one. This indicator is called Macro Trend Decode, and it includes 16 macroeconomic indices and tracks the 6 largest economies in the world. The idea, yes, is impossibly simple, but it will have to wait years for it, and not many will have enough patience. Buy during red bars and don't buy during green bars. During the green, you can even sell. The higher this bar, the more willing to sell. Why is macroeconomics important? Here is a simple example. Every time the Consumer Sentiment Index fell into the range of 50 to 63, 12 months after that, the S&P500 showed an increase of 19 to 30%. So this needs to be monitored. And there is an interesting picture on the stock market right now. Investors are starting to catch the real Thomas. Greed is even higher than on cryptocurrencies. So much higher that traders are starting to merge certain categories, for example, healthcare, in order to free up money for investments in tech companies. And here I want to emphasize that these are mainly retail investors. Retail inflows are breaking all records, and the put-count ratio is approaching the lowest level in history. This means that there are a lot of bulls in the market. And is it unlikely to end well for retail investors? And I would rather turn my attention to healthcare, firm which retail investors are fleeing, and not to techno stocks, into which they are fleeing. Moreover, if we compare healthcare companies and S&P500 companies, we can see that the techno stock sector has already been overbought, and healthcare, on the contrary, has been oversold. Historically, retail investors like to sell at the bottom and buy at the highs. For example, the largest outflow of retail investors occurred in the 22nd-23rd year, just when it was necessary to buy. Therefore, whether they are doing the right thing, that they are buying off shares so record time will tell. However, the behavior of institutional investors is also unusual. It seems that this is one of the few cases when institutional investors are trying to catch up with retail investors. As part of the FOMO in the stock market, we see how quickly hedge funds and banks, which recently buried the economy and predicted a recession, are changing shoes. The chances of a recession dropped from 70 to 37% in a week. And it looks like recession fears are melting like butter in the sun. And here are the latest results of the Investor Sentiment Survey. 35% of investors are bullish, and only 44% are bearish. For the first time in 2 months, the number of bears has fallen below 50%, and finally, the percentage of bulls is close to the historically average, 37.5%. So we broke this record for the number of consecutive weeks with extremely pessimistic indicators. For 11 weeks in a row, there was pessimism comparable to the financial crisis of 2008. And now we are seeing a shift in sentiment. Investors are buying techno stocks, as well as shares of companies that are focused on innovation. Maybe it was influenced by politics, maybe something else. But interestingly, this happens even at the institutional level. In addition, we have just witnessed one of the sharpest collapses of the volatility index in history. 6 weeks ago, this index reached 60 points, and today it has fallen below its 200-day moving average. Ethereum has returned above its 200-day sliding average. This is a positive sign, in fact. And if he stays above her, if she stays as a support, then I still expect him to go into that range. From $2,850 to about $3,400 before falling again. By the way, returning to the volatility index, it is much more profitable for a retail investor to trade it. Why? Because the shares of any company are subject to insider trading. Each company often has hundreds of people who have access to confidential information about that company. Now add here all their relatives, friends, cousins, neighbors, and so on. All of them may accidentally hear this information, for example, at dinner. This is in addition to the fact that fund managers have personal relationships with the company's boards of directors. A lot of joint lunches, emails, calls. That is why retail traders are in some way at an information disadvantage when it comes to trading companies or stocks or cryptocurrencies. Now look at the H video. For the second day in a row, it is trading above its 200-day moving average. At this time of year, this stock usually has a bullish seasonal effect. We'll talk about that later. I think this is also influenced by the recent visit of Donald Trump to Saudi Arabia. How is this related? The fact is that in addition to Trump, the CEOs of BlackRock, IBM, Amazon, Google, Palantir, Nvidia, and so on flew to the events. Elon Musk was also in Saudi Arabia and made a lot of loud statements, especially in the field of robotics. Against this background, Tesla shares, just like in the video, returned above the 200-day high and have been trading above it for the second day. Now they are trading around $350. However, there are traders who buy call options for $400, $480, and even $920 per share. That is, someone believes that Tesla's shares will rise to $920 apiece. And this is even despite the fact that the company's revenues for the first quarter were very, very bad. But we don't look in the rearview mirror to drive forward. And if we look to the future, Tesla looks brighter to me than ever before. We are standing on the threshold of one of the largest industries that we will see in our lifetime. These are robotic ride-hailing, robotaxi, robots. In this area, Tesla may well become dominant, not to mention the humanoid robots that Elon Musk talked about in Saudi Arabia. Elon Musk foresees the rapid approach of another world in which there will be tens of billions of humanoid robots, which will make Tesla a multi-trillion company. Elon Musk predicts that its capitalization will grow to $5 trillion and even perhaps to $25 trillion. But we are talking about a long distance, of course. For short and medium terms, there will naturally be falls, and perhaps even very, very painful ones. After all, as usual, people see investments as a straight line, but in fact it is full of horror, nightmare, and tragedies. And few of the holders can survive it all. Now, if you look at the 500 S&P index, we still have increased volatility. The market is moving quite actively. And here's what's important. If we can break through the level of 5,800 and gain a foothold above it, it will be a bullish signal. Yes, we are a little overheated in a short time. My indicator says this, the market is overbought. But this is not necessarily a reason for panic. If we do not fall below 5,780, then this is not just a surge, but a continuation of growth. Ideally, we want the market to hold the level of 5,780. This will be a good sign for the bulls. The main thing is not to close this gap, which appeared at the opening of trading. Its overlap may be a bearish signal. But there are always risks. We see that many investors re-enter the market, and at such moments, there can usually be a so-called crack of weak hands, that is, a sharp pullback much lower in order to scare those who entered too late, succumbing to Thomas and finally believing in this rebound. Such people usually do not have confidence in their positions, and therefore, they can easily fix losses as soon as they appear. And there are a record number of such people now. There has never been such a thing in history. And this is indicated by the VIX Volatility Index and its heat map right here at the bottom. They say that the VIX may still fall to 12 points, and then we will see a sharp jump in volatility up. And the heat map will move from dark blue tones to dark red again. On the way to this, we may see another sharp spike in volatility, and it can be used to lock in profits. But if unexpectedly bad news suddenly comes, as always, you need to be ready to act on the situation. Look at what the technique and fundamentals say, and start from this already. And one more thing, we are again seeing quite bullish activity in options. If you look at the ratio of puts and stakes, it starts to shift strongly towards the stakes right here. Investors buy more call options, that is, they bet on growth. And now about the market width, which we talked about in the last video. This is an indicator of how many stocks are involved in the market movement. And now we see that fewer and fewer stocks are trading above their 20-day average. In other words, not many stocks continue to grow, despite the fact that the index seems to be going up. In other words, the market width narrows as the stock market grows. This is called divergence, when the S&P 500 seems to be growing, but fewer and fewer stocks support this growth. It turns out that the growth is narrow, it comes at the expense of several large companies, and the broad market begins to slip. As I have shown earlier with the examples of Tesla and Nvidia, these are really key stocks now for the entire market. And at their expense, the S&P 500 is now growing. And you need to understand that the width of the market sometimes unfolds before the index itself. It's as if you were walking on a bridge, and suddenly the boards under your feet would start to wobble. The bridge itself has not collapsed yet. But you already feel that something is wrong. The main question that everyone has is when the correction will begin after this explosive movement that we have seen in the market. If you look at the seasonality, in the year after the election, then stocks, as a rule, find the bottom at the end of April. That's exactly what happened last month. And then we can observe growth until about June, here, after which there is a summer consolidation, a correction. After which we see a new peak around August or early September. And then a very, very weak third quarter, which lasts exactly from the end of August to October. And by the way, Bitcoin and cryptocurrency also seem to be preparing for a correction at about the same time. When compared with changes in global liquidity, here is the price of Bitcoin, a black chart, and here is the change in liquidity, a red chart. And as you can see, the change in liquidity is falling, but Bitcoin has not fallen yet. So far, Bitcoin has perfectly repeated these movements, which means there is a chance that we can see approximately such a correction of Bitcoin somewhere in the area of $88,000 to $90,000. Then, as a rule, the fourth quarter, which begins around October or at the end of October, is very good, as we see. If the market is already in the black since the beginning of the year, somewhere from the middle or the end of October, if history repeats itself, we can move into the rally period. And now the S&P 500 is still in the black since the beginning of the year. Of course, there are no guarantees that it will remain that way, but if, as we said, it holds 5,780 points, and it is even better to gain a foothold above 6,100 points, then the end of this year will look rosy. This will increase the likelihood that we will still finish the year in the black. Even if it will be a modest 5 to 9%, for the S&P 500 is very great. And just keep in mind that modern markets are moving much faster than in the 2018, and even more so in the last century. After all, over the past 25 years, there has been a transition from trading halls and telephone trading to online trading using smartphones. We may well be in an epic, as I call it, smartphone bubble. Perhaps in the future, this period of time will be called by analogy with the Tulip Ania 1600th years in Amsterdam. Only a smartphone bubble will be much more epic than tulips. Here is an example. Just 20 years ago, the two largest bearish collapses of the beginning of this century were restored. For more than 1,000 days. 1,165 days and 1,009 days, to be specific. But in the 2020th year, recovery from the coronavirus crash took only 103 days, 10 times less. We also had a slight decline in the 2022nd, and yes, technically it was a bear market. A drop of more than 20%. But in my opinion it looked more like another correction within the framework of a long-term bullish trend. And I talk about it all the time. Well, look at the 200-week price of Bitcoin. Where is the bear market here at all? I don't see him. And now look at the current movement here. It's starting to look like a B-shaped movement, and we're not so far from a full recovery, which could potentially compete with the 2020th year in terms of rebound speed. Keep in mind that the stronger the short-term movements, the more it speaks in favor of a positive picture for the medium term, and so on. On the 12th of May, 2025 year, just the same 58, as much as 0.1% of all shares, reached their peak in the last 20 days. Until the recent week of liberation, we were following almost the same steps as in 1968 year, 2025. Is a black line if anything. Initially, there was a very similar behavior to 1968 year, then. There was another similar movement along the trajectory of 1998 year here, this is the blue line. Then too, there was growth at first, and then the market made a strong pullback, even through a double bottom, before going up. But now the situation has changed a little, the market has been showing steady strength in recent days. And it looks more and more like it is finding its footing. And it is quite possible that we are following the scenario of 2018, this is this pink line. Then in the 2018 year, everyone also discussed trade duties, tension, low volatility. But the markets eventually recovered, and very confidently. And an important point, there was much more fear and pessimism now than even then, but despite this, we now see a green light. In almost all directions. For example, H-Video has been a plus again since the beginning of this year, and has already become the third company from the Magnificent Seven to do so. This is a serious bullish signal. Obviously, the market liked the deal between the US and China very much. It actually evaporated the risk that China would take retaliatory measures. Of course, this risk has not completely disappeared, but now it is already largely embedded in the prices on the markets. And this is very clearly seen in the IT for semiconductors. There has been a powerful recovery and growth. We opened with a gap up by more than 6% at the beginning of the week. And of course, Wall Street, as always, behaves like a flock of sheep and follows the crowd. Just a few weeks ago, they were extremely bearish, lowered their targets for the S&P 500 index, predicted a recession. And now they have abandoned these forecasts and raised their target levels again. Here, for example, are the latest comments from Goldman Registry Office. They say the deal between the US and China, and the US and the UK supports the markets. For Goldman Registry Office, it looks like a recent drawdown, which was of an event-driven nature and was temporary, without long-term damage, although I slightly disagree with this. Now that the situation has resolved itself, the market excludes the recession from its expectations, and has recovered most of the losses. Instead, while retail investors were buying up the drawdown, the institutions, along with their entire financial media empire, spread alarm in all directions, contributing to the formation of bearish sentiment. And now, on the contrary, by the way, they are now trying to form bullish sentiments. And now we are getting the message that hedge funds may capitulate. And we are seeing the second largest panic of closing short positions in history. Due to this, the market has soared even more, but at the same time, protective bond powers of attorney still do not attract investors, it needs to be emphasized. Confidence in US bonds is not returning, even against the background of the fact that President Trump's 4-day trip to the Middle East has just attracted $1.5 trillion of capital for the United States. Although Donald Trump himself says that $4 trillion bonds are still being sold off, and this leads to the fact that the yield of 30-year-olds is approaching 5%. This is still a big problem for Trump and Bessent, and they are already talking about debt restructuring, or even changing interest rates specifically for him. Nevertheless, analysts of the same institutions, banks, hedge funds are quickly changing their rhetoric. In their opinion, the negative dynamics of profit growth, which has been chasing American stocks for several months, is beginning to change for the better. So we can only admire how quickly modern markets change their agenda, literally in one day. And the whole of Wall Street simply has no choice but to jump on this wagon and quickly change shoes. But has this recovery come closer to its end than to its beginning? After all, we will have to see a rollback in any case. How deep it will be is another question. Will the S&P 500 be able to stay above its 200-day sliding average? And will we be able to hold this giant gap that opened this week? At the very least, we need to test it. The technical signals we are getting now are good for the medium term, but fundamentally we are still not out of the woods. The world still has to adapt to the highest tariffs and the sharpest growth from the world's largest economy. Goldman Registry Office still believes that the base level of effective tariffs will remain around 15%, which is still higher than before the start of the trade war. Even despite the de-escalation with China, the tariff increase still occurred, and some retail chains, such as Walmart, ignoring the recent de-escalation with China, still use these tariffs to legally raise prices, which, of course, will affect inflation. The risks still remain. Inflation may rise again, people may start spending less. And do not forget about the damage that the market has received over the past 6 weeks. Its consequences may be felt for quite a long time. For example, the Allies' trust in the United States will take a long time to recover. And here, for example, are the latest statistics on inflation for April in the United States of 2 and 3%. But in April, we also saw a drop in consumer spending. Deflation also occurs for this reason. I'm not saying that we're going to shoot new record peaks right now and everything will be perfect. Because if you look at the indicators, there are signs of overheating of the market in a short time. It is also clear that volatility has slightly increased recently, and some stocks no longer support the overall growth. This is called divergence and narrowing of the market width. If you look at Nasdaq, more than 24% of the shares are in the overbought zone, according to the ARSA indicator, exceeding the level of 70 points. This usually portends weak returns in the next 3 to 4 weeks. Most often, the market really corrects 4 days after that. And even after 2 or 3 weeks, the results are mostly red. On average, minus. And by the way, look, 4 days after this indicator reaches 24% and above. Only once the S&P 500 was green 0, as much as 0.52%, in other cases it was red. And if you look at the exchange-traded fund, QQQ, this is a basket of 100 of the largest technology companies in the United States, then we see that it is in an overbought zone. Right here in the red zone. And if you remember the last 2 times it happened, it was the 16th of December of the 24th year. And the 9th of July of the 24th year. What happened to this index then? In July it fell by 16%, in December by 7%. And it was a clear signal that here the power of this movement was exhausted. Just as here, the power of this movement has also been exhausted here. Now we have a similar situation. We are overheated, volatility is growing again, so I wouldn't be surprised if we see a correction over the next 3 weeks. And here's another graph. When it is above this line and turns red, the overbought zone comes. We haven't reached it a little bit yet. After this overbought zone, if we compare it with the price chart, we see small corrections. But the key thing is whether the market indices will stay above their 200-day moving average after this possible correction. Moreover, it is here near it that we see this gap. History shows that it should hold, and a year later, this correction should seem like just a new opportunity to buy. Look, a year after all these events, the S&P 500 has always been green, which received a contract with Saudi Arabia in the amount of $15 up to $25 billion. MD also announced a plan to buy back its own shares for $6 billion. And I think that the de-escalation with China, as well as the last visit of Donald Trump to the Middle East, which opened the floodgates for new deals worth trillions of dollars, provided serious support to the American giants and the AI sector. And we must remember that Saudi Arabia and other countries in the region have a lot of cash they earn on oil, which they then sell to the West. But expectations of new orders after all this showed the biggest monthly jump in history since the index was created in May 1968. Tesla also turns from a stock into a kind of call option, that is, a bet on the future. It is difficult to imagine a person who would not like to have his own humanoid robot. And today there are more than 8 billion people living on Earth. It is also difficult to imagine a business that would not want its own humanoid robot to perform useful tasks. And there are more than 360 million companies on Earth today. This is exactly what Elon Musk meant when he said that Optimus would be 10 times bigger than the company's next largest product. In other words, if you are an investor in Tesla, then each of your shares is an indefinite stake option for this future. That is, a bet on the future. And here, for example, Netflix claims 94 million monthly active users who use their tariff with advertising. That is, a non-standard subscription, but a cheaper option, where ads are shown during viewing. Now that 94 million people watch content with ads every month, this gives Netflix a huge advertising audience. And advertisers are willing to pay more to show their ads to such a massive and engaged audience as Netflix. Therefore, the more active users there are on the advertising tariff, the more advertising revenue. And this makes Netflix's business more sustainable and profitable, especially over a long distance. In short, Netflix will now earn much more from advertising, and the market, as can be seen from the graph, perceives this very positively. Now Netflix has a capitalization of about $490 billion. I think that anything below $400 and especially $300 billion is a good opportunity to buy. I believe that Netflix will become a company with $1 trillion of capitalization, and maybe even more. Several trillion dollars over the next 15 years. And finally, I want to show you one concept that Warren Buffett understands, but most investors miss it. Why do stock prices just go up over time, no matter what? Many people think that the share price is rising only because of inflation, economic growth, or because the company is starting to earn more. This is true, but there is one thing that many investors do not see, and that is retained earnings. Let's imagine a simple situation. The company earns $10 per share per year, and its book value, that is, how much it is really worth, taking into account assets and debts, is $100 per share. If a company does not pay dividends and does not spend money on repurchasing its own shares, but simply keeps the profit, investing it, for example, in bonds, then the book value next year will already be $110 a year later. Another $120, and this is without profit growth at all. Now let's assume that the market values a stock as 1.5x of its book value. This means that at $100 of book value, a stock is worth $150. At $110, a stock is worth $165. At $120, a stock is already worth $180. And we have not yet taken into account either profit growth, new products, or the hype around the company. If the company really starts earning more, and investors want to own its shares, the price may rise even more, due to the growth of multipliers such as price to profit. That's why Warren Buffett likes to buy quality companies at a reasonable price. He knows that in 5 to 10 years, they will almost certainly be worth more, even if they just work quietly and keep their profits inside the company. And if they also start buying back their shares from the market, growth will accelerate even more, because the same profit is now divided into fewer shares available on the market. This is the magic of complex growth and retained earnings. Not everyone understands it, but it is one of the key factors why the shares of companies have been growing for years. And by the way, in the last video, we talked about the fact that the shares announced by Baebeke this year could become a record. What is the result? The market is a little overheated, except for certain industries like healthcare. Too many retail investors have entered the market. Hedge funds have capitulated, closing their short positions. In the next 3 weeks, the S&P 500 may undergo a correction to shake out extra passengers. Ether, it seems to me, is too hyped now. There are too many positive forecasts around it. This hints that it has less growth left than one might think. Bitcoin may experience a correction this summer. But if you look further, the horizon is clear. Money continues to look for new directions, technologies are growing, capital is flowing into the future. the economy has withstood. Orders are growing and investments are being attracted. And most importantly, the trend remains in force. Therefore, now is not the time for fear, but also not the time for euphoria. This is the time for strategy, for discipline, for confidence in why you are here, so that you find high-quality companies and high-quality cryptocurrencies. Among cryptocurrencies, such searches will be much more difficult because 98% of altcoins are dumb fireplaces. Yes, there will be volatility in the short and medium term, but it is those who did not run after the crowd, who stood up, who did not depart from their plan, who held the position, who will eventually win. Because strong hands like Warren Buffett build wealth over a long distance. And if you are one of those, this market works for you. See you in the new videos. See you soon.